Hello everyone, I'm Devi Alvis from Qatar MBA Batch 2020, subgroup number 2, with my group mates Rajitha, Nalak and Pramukha. We will discuss about the insider trading today. Before we move on to details, let me take you all through the content first. We will give you brief introduction about the insider trading and we will explain three key questions, determine and how to avoid insider trading, and we will present theoretical background, practical aspects, and finally we will give group viewpoints. Move on to next slide. What is insider trading? Insider trading refers to the illegal practice of trading on the stock exchange to one's own advantage through having access to sensitive and important inside information before it is published officially to the general public. This information is used to gain money via stock exchange. Unethical investors always try to grab information earlier than that will go to public. Moreover, insider information is more apparent in efficient markets such as in US, London, Australia stock markets. So investors who are in efficient markets, information is very much required for them to make more money. Hence, investors try to go for illegal things. That's where insider trading emerge. Move on to next slide. Why insider trading should be avoided? I will give you a classic example. Forbes in 2013 highlighted Raj Rajaratnam was slapped with 11 years in prison after profiting 80 million from transactions involving Goldman Sachs. That clearly show why we have to avoid insider trading. So it might harm the investors as well as society. That's why insider trading should be avoided. It will affect in many ways, such as it is unethical behavior that shakes investors' trust in the market and makes them less likely to invest or partake in trade. Insider trading is unfair and discourage ordinary people from participating in markets and making it more difficult for companies to raise capital, and manipulate of stock prices as a form of fraud, harm both society and individuals by decreasing the accuracy of pricing by the market, and managers may delay the transmission of information to superiors if insider trading creates incentive for them to do so. So move on to next slide. Is insider trading a criminal offense? Yes, it is. If the insider trading fulfill the three key conditions, as you all can see in the slide, if these three conditions are answered in just then the person has committed a crime related to insider trading. So those questions are: did the insider leak sensitive information of the organization before it is released to general public? And then, did the insider act on the information obtained by him? And before general public, did the insider make money out of them? So if these all three questions are answered by yes, then that person have committed the crime related to insider trading. Rajita, over to you to explain about theoretical background for insider trading.
Thank you, Devika. I will take you through the theoretical background about the insider trading. And insider trading can form in an organization with the members of an organization, professional consultants, government officers, officials, and friends and family of the employers. And to prevent the inside trading all over the world, inside trading laws are introduced, and there are law and sanctions for implemented in different countries. When you take example as India, our neighbor country, they have 250 million Indian rupees, or 3 times amount of profit made out of inside trading as a sanctions. And in Australia, different penalties for individuals and corporations under the Australian Act. And in the British Financial Service and Market Act 2000, they have sanctions of maximum allowable prison sentence of 7 years or unlimited fine. And in Japan, maximum allowable prison sentence of 3 years And in the Singapore, maximum allowable prison sentence of 7 years. And in the United States, maximum allowable prison sentence of 20 years, fine up to 3 times of the profit made or loss avoided. And when I take in the theory about the insider trading, mostly famous theories are classical theory and misappropriation theory. But I will take you through 2 new theories. One is unfilled theory of inside trading, and this unfilled trading is argued that the classic theory of inside trading has absolute its usefulness because of fail to do what the theory must, which is explains settled law and provide answer to the unsettled law that are naturally appealing. Instead, court should replace the classical theory with the alternative, the misappropriation theory, which court currently limit to cases involve inside trading by outsider non-employers. The corporate holds securities from the basic of the trade. The result would be finally unifilled theory, the combination of the classic theory and misappropriation theory. And moving forward with the second theory, shadow trading theory. Then shadow trading theory, the green light to pursue a novel theory of inside trading, bubbles shadow trading. Unlike trading inside traditional inside trading, so-called shadow trading involve using material non-public informations. And this theory seeks to broaden the prohibited using material non-profit information to encompass effort to exploit the securities of an economical link businesses. Although the court did not reach the merit, it is ruling endorses the sweeping expansion of insider trading liability carrying potential consequences for all public companies. And we will take you through the practical analysis by Nalaka. Over to you, Nalaka.
Yeah, thank you, Rajita. When we talk about this insider trading activities, in today's business context, we have so much of examples to talk about. So we will take few of them to analyze the case. So we have a very famous case of Mr. Raj Rajaratnam and Rajat Gupta, how they professionally did insider trading and profited and got caught. Raj Gupta is a director of Goldman Sachs, and Mr. Raj Rajaratnam was a Sri Lankan American who was involved in stock trading. So he is a good friend of Raj Gupta. So when Warren Buffett agreed to pay $5 billion for his preferred shares of Goldman Sachs, this information was given by the Raj Gupta to Raj Rajaratnam, where Raj Rajaratnam bought 175,000 shares immediately, and he earned 17 million USD. But finally, he got caught, and the case was gone. Case was in U.S. court, and both of them were fined, and they were given imprisonment periods. Similarly, we have a case of one Japanese guy in 2006, Mr. Yoshiki Murakami. He made 25.5 million using non-public material information about Livador, a financial service company that was planning to acquire 5% stake in Nippon Broadcasting. And he, from his fund, he took this shares of this company, and then he made this much of money. Finally, he got caught, and he was given punishment as per Japanese law. We have a similar case in USA. Joseph Nakoy, he made $50 million by dumping his stocks on the market, where he was the chief of QS Communication. And that time his company was having a lot of financial problems. But he gave wrong information to the shareholders, and that he made this much of money. But finally, when US government got to know this, he was punished, and he was given necessary punishments, and even the he was sentenced to jail. So we have another case where our next door neighbor, Indian guy from he's Mr. Sarab Mukherjee. He paid 1.38 crore for involving insider trading activity that came into the limelight of Indian government, and then he paid off. So as we most of us MBAs working for corporate organization, we have to be very much be careful about the sensitive, price sensitive, stock sensitive information about listed companies. So it is very important to understand that the information that we pass to the outsiders as corporate workers, we should not give it as a golden rule. We should never give any information until they are published. So over to Devika for our conclusion.
Thank you, Nalak. If we move on to our group viewpoints in terms of insider trading, we could see illegal way of trading mostly in efficient markets, such as insider information can be more attractive and make more return as they are acquired to guaranteed source. Investors tend to get more into inside insider trading, and insider trading can be extremely dangerous as the public exposure would mostly be negative as it is illegal, and people may not want to deal in the financial market due to insider trading, as they may believe that the entire system is rigged. So as Nalaka mentioned, we should not give any leak any sensitive information as the golden rule if we work in a listed public listed company. So therefore our group viewpoint is the insider trading should be eliminated and law should be properly implemented to protect genuine investors. Our next slide will show the references, and the next slide show the our group members. Thank you very much.